Last year, the market we got asked about all the time was Washington, D.C., and this year, it's Houston. Everyone wants to know, with low oil prices, what does that mean for the Houston economy and for the local apartment market? We're going to take a look. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Houston update. Every year, the Urban Land Institute releases its Emerging Trends Report, which is a must-read for anybody in the commercial real estate industry. It released its 2015 report back in October of last year, and it identified Houston as a top market for 2015. Well, just around the same time, oil prices began to drop, and all of a sudden, everyone went from bullish on Houston to concerned. Economists slashed their job forecasts, some real estate prognosticators predicted some dark days ahead, and some lenders started to redline Houston altogether. But now it's been 3 full quarters since oil prices started to fall. Are we seeing any effect yet? We're going to take a look, and the answer is, as usual, yes and no. It took a while to show up, but finally we are seeing a little bit of a slowdown in the labor data. It's nothing close to a doomsday scenario, but the brisk pace of job growth in Houston has given way to more moderate growth. Houston has gone from a top performer to closer to the mean, with 56,000 jobs added in the past year, amounting to growth of 1.9%. And again, those are good numbers for most any market, but as you can see, it's a big drop-off for Houston, and this is about what we expect to see going forward as well. And how about the local apartment market? How has it been affected? Well, the good news is that overall fundamentals remain strong. Resident retention remains very good at 51.6% as of Q2, and that was actually up 60 basis points year over year, meaning that a larger share of renters are renewing their leases. And they're paying a premium to renew as well. Residents are paying on average 5.4% more than their previous lease to stay put. So demand has not slowed down, and as we see that also in the occupancy stats. Occupancy hit a new high for the cycle as 94.7% in Q2, and drilling down deeper, that rate is really lifted up by Class B and Class C product, both around 95%, while Class A is at 93.8%. And that's really the key storyline going on here. The overall strength of B and C, and the slowdown we're starting to see occurring in the A's. And that's going to play out in rents as well. Effective rents for new leases, really strong for the market overall, 5% growth year over year. But again, drilling down deeper, that storyline plays out. Escalation in the Class B and C rent growth, 6.7 in the Bs, 5.9 in the Cs. But in the Class A group, it's really dropped off to just 1.8% year over year growth, well below the previous numbers. So what's happening is that there's a huge block of new supply hitting the market, some near record levels, all the Class A variety, and generally very concentrated inside the Loop and out west in the energy corridor. And you can see that's really started to lead to the slowdown in what we're seeing in Class A rent growth and also occupancy, slowing lease-up velocity for new supply, as well as dampened pricing power for the existing properties in those areas. And what's happening is that in the oil industry, the jobs in Houston are generally high-paying jobs, office jobs, very little exposure to actual oil field jobs. Those jobs are in southern Texas and West Texas, not in Houston metro area. And that's why the Bs and Cs have held up really well. And we expect the Bs and Cs, as well as the suburban product in general, to continue to do well going forward. Now, as for the Class A and for the urban product more specifically, the crystal ball is a bit foggy given how it's so tied to the oil industry, and it's hard to say what's going to happen with oil prices. Obviously, that's a tough thing to forecast, but we're expecting continued flatness for those segments overall in the short term. The good news, though, is that new starts in these areas are slowing down. And what that means is that by, let's say, about 18 months from now, demand should catch up with supply, and that should allow for some improvement in fundamentals. And that's going to wrap us up for Houston. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.